Hey, today we're going to talk about something called velocity banking and two ways that I use a HELOC or a home equity line of credit. First, some definitions. What is velocity banking? And to be honest with you, I just recently heard of the term. I come to find out that what I'm doing is velocity banking and a HELOC. So velocity banking, what is it? It's basically, it's kind of a play on the whole idea of the velocity of money, right? And that the velocity of money is how many times money is exchanged within the economy. And, the higher the velocity of money, the stronger the economy, and vice versa. So the velocity banking is a kind of a personal use where a person uses lines of credit to exchange money faster or increase the velocity by putting it to use in different ways. And I'll explain it further here in a minute. But that's kind of the gist, right? So the velocity, you're increasing the use of your dollars essentially. And so again, I didn't know that term existed until recently. And basically, what it is it's just whether you have, say, equity that's sitting there being unused and then you're putting it to use. That's one idea, like I said before, or it's also used as a kind of a way to pay off debt quicker. All right, so that's kind of, and in fact, most of the time, that's how, when people say velocity banking, you look it up online, most people are using it to pay off debt quicker. And it can be definitely used that way. So it'll be helpful if I explain two different ways that I use a HELOC, and then we'll come back to velocity banking. All right, so a HELOC, home equity line of credit, is basically where you take equity that you have in a home and you turn some of that equity into a revolving line of credit. Okay, a revolving line of credit that is not a mortgage and is, where the interest is calculated daily. And usually HELOCs are they're open, they're revolving for 10 years. And then they kind of revert to something that's more like a mortgage. Okay, but I'm sure that there's different banks who use them in different ways. They probably have different products, so you'd have to definitely be very mindful of that and do your own research regarding HELOCs if you're going to use a HELOC. Okay, so for me, I have a HELOC on my personal residence, right? And this gets into, more on risk and things like that. But I'll show you two ways. Okay, so the first way is something that I did years ago, is I took a HELOC out on my personal property. And so that's, again, a line of credit. And then I used that line of credit to buy a rental property, right? For basically the down payment on a rental property. And therefore, that down payment was made, and I used an additional mortgage to buy that property, right? So it was a down payment from my HELOC plus a mortgage on the rental property bought. Okay, so no money out of my pocket. Put renters in that property and, renting out the property like you would any other rental property. Now, with that, the rent that I get from that property covers the mortgage and the payment on the HELOC, plus a little bit of cash flow. Okay, not a lot, but a little bit. Okay. Now, so how does that tie in? Right. So obviously, again, I use the HELOC to acquire an asset, and so I acquire the asset, and then I I'm able to, obviously, you know, there's the risk there of having the asset. But in the case of the last couple of years, just outrageous fake appreciation, right? I mean, anyone who's following this understands it had massive appreciation in that rental home. And, you know, so be it. That's just the way it is with the increased money supply, inflation, et cetera, et cetera. All right. Now, for me, like, I'm not a flipper, right? So I'm just buying and holding that property. So honestly, my main concern is not the appreciation in the property. But let's go back to the HELOC. Okay, so again, I told you that's where the down payment came from. So when I receive rent, so this is kind of getting into the whole velocity banking. When I receive rent, that money immediately, all of it, goes to the HELOC. Okay, so remember the HELOC, the interest is computed daily. So the more that you can lower it, even if it's just for 10 or 15 days, you're lowering the amount of interest that you're paying. So again, I take that money, it immediately goes to the HELOC, and then I pay the mortgage for the property and, you know, any repairs. There's a couple of utilities that I pay because just the way the location is, that, you know, whoever owns the home has to have a certain utilities in their name. But again, that, you know, that just gets added on to the rent. So again, that money all comes in, goes to the HELOC, and then that HELOC is used to pay those bills throughout the month. And it's just a few of them. And it's all perfectly fine to pay from the HELOC, or I guess what I have it automatically transfers to the checking account that's associated with that same bank. And then those bills are automated to pay from that checking account. Okay. So in other words, that money is flowing into the HELOC and it's lowering the interest, and then it's getting paid out throughout the month. Okay. So that's a lot of basically money is being used twice. It's money that I was already going to spend on those bills, and it's lowering the interest for me. Okay. All right. So in a miniature form, that is velocity banking. Okay. Some people do it with credit cards. They do it, you know, you got to be careful out there. There's a lot of good information out there, but there's some kind of weird and shady ways to do it. Got to be careful. Really got to kind of calculate the cost of everything, think through all the different factors on both sides, and then, you know, execute and then test it and measure it, right? So it works for me with this whole HELOC thing because I have cash flow, right? So my overall balance on the HELOC is going down faster because I'm paying less interest, right? I'm also, in this case, I'm not taking that extra cash flow and putting it in my own pocket. It's going right back in to kind of paying off that HELOC. Okay, so I'm not taking it, but I have an asset now, right? That's the difference. Zero money out of my pocket, zero money into my pocket. I don't have to do it that way. I could take that positive cash flow, and you know, just pay all the minimums or whatever. But in this case, it makes more sense for me to do it this way because I just don't need it otherwise. But that asset is overall impacting my wealth, and, you know, long term, I'm going to be able to, you know, get positive cash flow from it. If I want to, if I need to, I can do that. And then as, you know, as over time, as rents go up, as inflation, you know, basically destroys, you know, the cost of that mortgage, It's just making a lot of sense for me. Okay, the second way that I use the HELOC, again, so I use it to acquire rental property. Okay, the other way is if, let's see, what are some other things I've done? Okay, so I've done things like, all right, so we have businesses, and you know, at the end of the year, we pay taxes. We pay lots of taxes throughout the year, and then I always end up paying more taxes at the end of the year. All right, now you know, normally I think, you know, a smart idea is to like say, hey, if you're going to take a draw from your business or something like that, or you know that you're going to end up paying a lot of taxes at the end of the year, it's good to have a set aside, you know, for like a tax account, right? So you're building it up knowing that you're going to have to pay it. And hopefully you're putting it somewhere that's going to give you interest, right? Which is really not the case nowadays. You're not going to get it from a savings account. You're not going to get interest from even a money market account. You know, none of that is really paying out any interest. It's certainly not keeping up with inflation. All right. If the stated numbers, like the official numbers, are at 5 point something %, then the actual inflation is much higher. And if you don't believe me, then you can look it up and you can go back to like, what would inflation be today if we measured it the same way we did prior to 1990, prior to 1980? And I'm telling you, the numbers would be much higher. Right? And I've done videos on this in the past, and you can look it up. But the second way is that I have other monies also flowing into the HELOC. Okay, other monies from besides rental income. Okay, W-2 income flowing into the HELOC, and then the HELOC's being used to pay certain things, like taxes at the end of the year. I don't set aside cash to pay taxes. I have that money flow into the HELOC in this case, and then I just have an understanding, like at the end of once tax season comes, I'm going to have a chunk of taxes to pay, and I'm going to pay it out of the HELOC. Okay, I know that, but in the meantime, I'm pushing down and lowering my daily interest rate and overall interest rates and overall money on the HELOC. So instead of putting it in a savings account where it's getting almost nothing, at the very least, I'm pushing it into a HELOC. Even though it's a low interest rate HELOC at say 3.5%, it's better than basically nothing. Okay. So those are two ways to do it. Now, like I said, with velocity banking, people get very intense with this. They're very creative, actually, so you can use it even more. You could, you know, every single dollar that you get can flow into your velocity bank, whether, you know, into a line of credit or whatever, then you could pay your monthly expenses out of it. You got to be very careful when it comes to things like credit cards, and people can even successfully use credit cards to do this kind of thing, but you have to be careful and watch fees that you're paying when you use a credit card to pay certain bills, right? For certain things, it's no problem, right? So if you normally go out to dinner and you spend, let's just say $200 a month in entertainment, dining out, whatever, that's your you know, budget or whatever. And instead all your money flows into your credit card, and then you use your credit card throughout the month to do those things. Something like that probably is fine. But trying to pay like your mortgage or something like that with a credit card, you're probably going to get hit with fees, right? And you're probably going to hit with fees that are more than what you're saving on a month-to-month basis doing velocity banking. Okay, so just you have to watch that. You have to just really, you got to do the math on it and see what makes sense, what doesn't make sense. You can do a partial velocity bank. Let's say you have you do have some credit card debt, you're trying to get rid of it, all right? And so you're going to use velocity banking to get rid of your credit card debt. And so, but you have these 3 bills or whatever that that they're going to get, they're going to get paid throughout the month, right? And let's say you get all your money on the 1st. Right, so you immediately put it into the credit card, or a portion of it in the credit card that would match those, say, 3 bills that are getting paid throughout the month. You use your credit card just to pay those 3 bills, all right? over time, that's going to save you a little bit in interest. You just have to be careful how you do it. Hopefully, hopefully that makes sense. But again, the point here is HELOCs are great things to utilize if you utilize them well, if you use them to buy property or other assets that produce cash flow, right? Or you use them in a manner like we talked about with velocity banking. All good things. Just make sure you're not misusing HELOCs. That's easy to do too. People who are buying boats and things like that, or cars, generally not a good thing to do with a HELOC. All right, so there's some exceptions to that, but I would just caution you to be very careful using a HELOC for anything other than, say, acquiring assets, or like you've got 2 or 3 other pieces of debt and you consolidate it in HELOC and then use velocity banking to get that HELOC paid down, right? I think that's a pretty good use of a HELOC as well. All right, I hope this cleared it up. Let me know if you have any tips as well that you would add to this. I know there's a whole lot more to velocity banking, but I just wanted to give you a couple of use cases for it. All right, talk to you later.